let's get down to business, taking a look at Wall Street. Dow Industrials up 330 at 11,433. The S&P 500 up 39 at 1,194. NASDAQ Composite up 86 at 2,566. 10-year note yield moved a little bit higher to 2.07%. Oil with a nice gain up $2.77 at 85.75. Precious metals moved higher. We'll have the precious metals report in just a bit. I must admit, though, that they're rather strange, these little rallies we've seen lately. With every little rumor of the day, the markets jump up. There's the old saying, the market climbs a wall of worry, but I don't know. What's the worry? The overriding worry has been that Europe will fall over and destroy the world.
What's happening in Europe, which they have not fully healed from the crisis back in 2007 and never fully dealt with all the challenges that their banking system faced. It's now being compounded what's happening in Greece. So they're going through a financial crisis that is scaring the world.
So the world is scared, and according to Sir Mervyn King, governor of the Bank of England, we are in the midst of the most serious economic crisis we've ever seen. Really? King holds the comparable job to Ben Bernanke, head of the British Central Bank. And King explained why the Bank of England decided last week to pump money into the economy.
Today we decided to create £75 billion of new money and inject it into the economy. And that will be spent by the people who sell government bonds to us. They'll be buying either things, or they'll be buying financial assets. They'll be buying securities issued by companies that want to finance themselves. The money will seep around different parts of the economy and will tend to stimulate demand in the economy as a whole. So this has been done to support the level of the British economy. Well, it will certainly affect the yields on various assets that people want to issue to finance their businesses. It will affect the wealth of pension funds and indeed individuals who own financial assets, and that we would expect would affect their spending.
Okay. So more quantitative easing from the Bank of England, and by pumping money into the economy, of course, we mean flying a helicopter above the city and shoveling out pound notes on investment bankers. I guess that's the only thing England could do, a fresh round of quantitative easing. If not, then, well, as President Obama just said, the entire world would be paralyzed in fear. But the pure serendipity to survive the most serious economic crisis ever, to not just survive the weekend, but, hey, we even got to enjoy a little football. That alone would be reason enough for a 100-point gain on Wall Street. But then we got the daily rumor. German Chancellor Angela Merkel and French President Nicolas Sarkozy said yesterday their goal was to come up with a sustainable answer for Greece's debt woes. They hadn't actually found a sustainable answer, but it now appears they want to find a goal. When news of the intent to search for a sustainable answer was trumpeted across Euroland, there was great rejoicing and just a very little gnashing of teeth. The markets moved higher in Europe, then the markets moved higher here in the good old USA as the traders on Wall Street marveled at the tenacity and boldness. There was great rejoicing and just a little gnashing of teeth. A spokesman for the German government emphasized that the talks are no miracle cure. He was quickly dismissed as a speculative short seller, and an arrest warrant was issued in Paris. That's what they do with short sellers in Paris, you know. While the ECB is a central bank in almost all respects, what it isn't is a lender of last resort for individual Eurozone nations. That role is expressly ruled out by the European Treaty. A lender of last resort is what stops a bank run on a solvent institution from bringing it down due to a lack of liquidity. In the case of a nation, A lender of last resort, usually the central bank, can simply print money to satisfy debts in its own currency. The fact is that markets take on their own momentum, and the ECB is not a backstop. So now investors are busy driving up the price of even German default insurance. This is the logic of the markets when they view sovereign borrowers as credit risk. It's almost inevitable that they push, and in pushing, they weaken the unbackstopped borrower, and ultimately, they bring it down. This is a process which calls for a circuit breaker, and Europe has no circuit breaker, unlike Britain or the U.S. So Europe is at the mercy of the markets, left without a central bank or outside force which can break the cycle and impose order. The ECB has purchased government bonds as a backdoor means of providing support, but the ECB can't buy an infinite supply of bonds. So what can we learn from the problems in Euroland? Well, this confirms that if you have a central bank, like the Bank of England or the Federal Reserve, it's a blueprint for corruption. You can literally run up mountains of debt. Conversely, if you don't have a proper central bank, you ought to keep your debt profile thin so as not to attract too much attention to your vulnerability. What it also shows us is that central banks are very skilled at hiding debt and suppressing free markets. Without a central bank to cover up the debt trail, the Europeans are going to have to figure out a way to monetize their debt or face default. And watch the domino-style run on government credit. That seems to become the self-filling route that is followed at that point. We've already started to see this. Italy being weighed by the markets, the failure of the Belgian bank Dexia. Without a central bank to obfuscate accountability, Germany might actually realize that they're being forced to pick up the dinner check for France. But for today at least, Merkel and Sarkozy were such a lovely couple, and the markets rallied. Gotta love the rumor of the day. The euro on track for its best daily rise since July of 2010 at about $1.36, pairing some earlier gains. Crude oil rose on the optimism of the day. We were up, what was it, 277 at 85.75. Bond markets were closed in observance of Columbus Day. Otherwise, they would have rallied too. After all, you got a rumor of the day. Now, changing topics a little bit. Last Friday during Open Phone's, caller claimed that banks weren't lending because of all the new regulations. I did not agree, but I wanted to find a little bit of information to back up my position. And over the weekend, I saw this report on CBS News, the nightly news with Russ Mitchell. It was a very good report on a small business out of Ohio, I believe it was, and their ability, or actually their inability, to get credit. Listen to this.
Ohio entrepreneur Kimberly Martinez saw opportunity in a post-9/11 world where ID badges have become parts of the working wardrobe.
Instead of wearing that shoelace-style lanyard given you by Marty in security, we create fashion accessories that let women really wear their IDs with style.
Martinez built Bonitas International from the ground up 8 years ago, using credit cards and the equity in her home. Today, she runs a $2 million enterprise with 15 employees.
Last year, we had our second best year in our company's history.
But growth and new hiring stalled when credit got tight, despite an excellent payment record, which CBS News has reviewed. Here's what happened. Before the financial crisis, Martinez was charging around $50,000 a month for goods and shipping. $50,000 with an $83,000 credit limit. But then, Chase Bank cut her credit limit down to around $50,000, meaning Martinez was now using nearly 100% of her available credit, a red flag that caused her credit score to drop from 700 to 640, which then triggered Chase to lower her credit even further to $40,000.
I'm in a spot where I don't understand why, when I've managed my relationships appropriately and responsibly, all of a sudden the credit card companies are turning their back on me.
In fact, 60% of entrepreneurs say their credit card terms have gotten worse.
I have clients who have orders in hand. They could hire employees back immediately if they had the cash to bring them back.
Former banker Marilyn Landis says bank computers don't discern between consumer and business spending.
I don't think the credit card companies have the data or the understanding to realize how significant their credit is for job creation.
I'm not spending my money buying plasma TVs and going on vacation. I'm spending my money to grow my business and create jobs.
When contacted about the Martinez case last week, Chase gave this statement to CBS News. As a standard operating practice, we may reduce lines for customers who are showing signs of increased risk. But the next day, Chase surprised Martinez.
You're my hero.
And restored her credit lines.
I'm so relieved.
After 2 years of uncertainty, Martinez hopes her company is back on track. And now that she's got her higher credit limit back, Martinez hopes to hire 5 more people.
Now, the interesting point there was this woman's credit was not cut because of regulations. They said in the piece that it was, and Chase said, it was standard operating procedure, not a government mandate. Now, the Dodd-Frank Act, that big regulatory mess that is designed to address the causes of the financial crisis, that's the newest target for what ails the economy. And it's easy to take shots at it. It's big, 848 pages. And it rules on trading derivatives and swaps and consumer protections. And this is the new symbol, the new target of government overreach. And this is what you hear is killing jobs. Except that only a small portion of the law, which was signed by the president last July of 2010, only a small part of it's taken hold. There are 400 regulations called for in the act. Only a quarter of those have even been written, much less approved. So there's this argument floating around that Dodd-Frank is the thing that's harming the economy right now, not the actual regulations. They haven't been written yet, but it's the uncertainty. Big business can deal with regulatory uncertainty, but it makes small businesses reluctant to take on risk and expand their operations. Really? Actually, small businesses are pretty good at handling uncertainty. If you are looking for certainty, you don't start a small business in the first place. Now, nobody wants burdensome regulations, and we'll see how Dodd-Frank actually plays out. But I think we underestimate small business. They can handle uncertainty. They can handle all sorts of craziness. What's tough is losing a credit line for no reason. What's tough is dealing with the bank's standard operating procedure.